Okay, everybody, welcome to tonight's webinar, Tax Tips Every Rental Property Owner Needs to Know. And I agree, great topic, Chris. That was Chris's suggestion on the topic. Beautiful. Every rental property owner needs to know this. Real estate investors, gosh, it's so amazing, the strategy. Chris is an expert. We're excited to have Chris on tonight. Before we start, I'm going to go through a quick introduction here on just some different things we have coming up, some resources. Of course, we always recommend, connect with us. We have a lot of different things, strategies, articles, different things that are always coming out. As you know, tax code is ever changing, always will be, always has been. And so if you want to connect with us, suggest YouTube. A lot of our webinar recordings are stored there for at least 30 days. So a question popped up there. They are stored for at least 30 days, if not more, on our YouTube channel, protectwealth.com/social, or I would say, our YouTube channel right there at the bottom. There's our URL, youtube.com/protectwealthacademy. You can see there, we have a lot of past webinars we do. And so take a look there, some good strategies there. If you've missed some of our last few webinars, go to YouTube. youtube.com/protectwealthacademy, and you can see our different webinar recordings there. A few of our different webinars coming up, some great topics. So if you can't make it live, jump on YouTube. It's a great strategy. Then, of course, our premier 3-day Asset Protection Wealth Creation Summit. Our next one is live streamed March 17th, 18th, and 19th. Guys, of course, a lot of you on the call have already been to our summit. If you haven't, or it's been a while, definitely suggest you come back. The tax strategy, again, is always changing. Asset protection strategy is changing. We always try to promote the best strategy possible to make sure your assets are protected. LLCs, corporations, trusts, limited partnerships. Don Pendleton will be covering a lot of that through case studies. Clint Coons, asset protection attorney, covers that in pretty good detail. We have tax attorneys, other advisors, and throughout the entire event, we have attorneys in the background answering your questions. I love that part because they're there answering your questions as best we can, specifically for you. And of course, if you want to see our agenda, hey, it's no small agenda. We've got pretty heavy content there. It really is. So take a look there. That's on our website, protectwealth.com. Would love to have you. And again, it's on Zoom. So you can do it from the beach, you can do it from the car, you can do it from the office. We love Zoom for that reason. It does give us the opportunity to reach more people around the world, literally. And of course, Chris, we're an asset protection company, so we always do a legal disclaimer. Of course, we're not giving specific legal, financial, tax, investment advice. If you're looking for that, look for a competent professional like Chris and his team. We're so excited to turn the time over tonight to Chris Danton. Tax tips every rental property owner needs to know. Now, Chris, I'll let you kind of introduce yourself a little more, but what got you into this space?
It's first of all, thank you, Kendall. Thank you, Don, for allowing me to be here. I started buying rental properties in 2011 with a business partner of mine. I had, the finances, but he was the boots on the ground. He knew how to buy them. I knew how the financing and get all that done. And I remember I started to, get like, wow, why am I able to offset my income? What is this about? This is like a depreciation expense. I get to actually offset my income because I own a rental property. And then all of a sudden I got a little bit further into it and I'm like, then I heard about what cost segregation was and about how I don't have to take my depreciation over 39 or 27.5 years. I can take it a lot sooner. And it's so just cool. Something that even my CPA, I've literally probably had 7 CPAs since 2011. Wow. And it took me all the way to 2018 for one to bring up. And remember, at that time, I had 51 rental properties. So it's not like I was just some onesie, twosie. I was a guy that was, had a big portfolio. And just until 2018, cost segregation was never brought up to me. And when it was, I was like, what? This might be an industry I'd be excited to promote. So here I am.
Yeah, see, that's awesome. See, as a real estate investor, and you know this, more millionaires are created through real estate than anything else by far. And because, and we know this, the tax advantages are huge. I can speak for me personally too. The tax advantages are huge. So we're super excited about this topic. Chris, I'll let you take control of the screen. Let's make sure that works okay. You go ahead and hit share.
I'll
I'll
do my
stop sharing on
best, my
my
friend.
end. There we go. Let's make sure that works. Then you
Are
can go
we
ahead
are
and
we official? Do you see me? You see my screen?
let's see here. Let me make sure. I don't see you yet, but that could be me.
Yeah.
Okay, guys, if you're on, you can see Chris's screen. Do a thumbs up because right now I'm not seeing it on my end, but that doesn't mean it's not there because sometimes.
Yeah, because
Thumbs
I'm
up.
share. It says share my screen. Up there it is. There.
There it goes. It just took a minute to pop up on my end. Okay, so we are seeing that. So what I'm seeing that, yeah, go back. Yeah, perfect. Perfect. And then, yeah, for some reason it just took a
Now are we
second.
good? Everybody good. Thank you. So you can
Perfect.
see it now? Perfect.
Yeah.
All right.
Okay. And then Chris, so you know, we'll do Q&A at the end a little bit if there's
Yeah.
questions. We have the webinar chat, but just so you know, our group usually uses the Q&A. Chat's disabled, but we use a Q&A screen, and we'll just stick to that. You know, a few Q&A here at the end if that's okay.
I'm wide open. Whatever is the normal format and however I can help. This is fun. So this is
All right.
awesome. I'm so glad you guys get to do this. So
Thanks.
thank y'all
Thanks,
for
Chris.
everyone being here. I know it's during the evening and hopefully you've had a little bit of food in your body and you're kind of in the process of relaxing. But I want to make this fun. This is not just going to be about cost segregation. I think this is really going to be about me telling you about my experiences from 2011 to 2024, that's 2025, and the conversations that I've had with my CPAs and the conversations I've had with other real estate professionals, because this is really all about optimization. And what I'm seeing, and I can tell you that 60% of my business does come from CPAs. But what I can tell you is CPAs are overworked. They don't have the time to do these things. And so we're really going to get into explaining either that you have heard about cost segregation studies and why you're not doing them, or you've never even heard about this. So I'm going to give you reasons why, because there's reasons. So we're going to get started. First, what I'd like to start off by, and if you don't mind, if you could maybe grab a sheet of paper, pen. I'm going to probably maybe 5 to 7 times, I'm going to ask you, hey, this is where you're going to take some notes, because I really want everyone to get something out of this, to learn something that they did not know about before they own real estate. Because maybe some of you guys and gals, are looking to be in the real estate business or already in the real estate business. So I'm going to talk to both to make sure that everybody's on the same page. So we're going to start off is talk about what is the word cost segregation studies. What are they? What starts off, it was a court case back in the late 1990s. And this is exactly how cost segregation was birthed. It was, Hospital Corporation of America versus the IRS. This was in the late 90s. And what happened was the hospital was coming to the IRS. And let's just say, for easy numbers, let's say this hospital was built for $100 million. The representatives for the hospital against the IRS basically were saying this: IRS, we just spent $100 million on a hospital. Why is my CPA having to take $100 million over a 39-year period? A hospital is considered commercial. So you take 100 million and it's called a depreciation schedule. So you actually get to depreciate 100 million over 39 years. It's just what was set by the IRS. So the attorney for the hospital said, IRS, we all know that building components have a tax life. And when I say tax life, what I want you to think about is when you have to renovate. The carpets only last so long. Air conditioners only last so long. So what the attorney was saying was, hang on. If I spent $100 million on this on this hospital, and you're making me take this $100 million and divide it over 39 years, hey, I'm going to have a ton of things that are going to depreciate a lot faster than 39 years. This is crazy. And that's when cost segregation was born. The IRS said, okay, we're not appraisers and we're not construction engineers. So if you're willing to hire a third party, construction engineers, they will be able to determine the tax life of the building component. But we're not in the business of doing that. So as of right now, you take your 100 million and divide it by 39, or you're willing to pay someone to place the building components in a shorter tax life, like 5 years or 15 years, rather than taking it over 39 years. So my point for saying this is this is the hard part about marketing, is if you hear the word loophole, you automatically assume like this is, hey, we're getting shady here. We're in the gray area. But this is a court case that was won. We've done 47,000 studies. We've been audited 22 times. Every single audit we passed. So my point is, you don't do 47,000 studies and be audited 20 something times in a loophole. It just doesn't happen. So it's very important that marketing is saying loophole, but I'm saying, no, this isn't a tax law. This is what real estate people do, but you have to be willing to pay for it. And I think that's where the disconnect is the average CPA is not interested in telling you, hey, do you want to spend $5,000? Do you want to spend $8,000? No, no, no. They're just looking in the tax law and they're saying, what can I do to help my client without having to ask them to spend money? But now this becomes a business decision. Am I willing to spend, let's say for easy numbers, $5,000 if it allows me to accelerate 200,000 that I can take now versus having to wait over 39 years? Now it's a business decision. And that's when the CPA always goes, hey, if you want to spend the $5,000, and the client's like, wait, of course, you're saying, would I spend $5,000 to get $200,000 of the benefit now? Yeah, of course I would. It's almost like a rhetorical question. But remember, it's not their money, it's your money. So this is why we need to be more proactive with our CPAs, because they're just worn out. They don't have enough time. They're doing the best that they can. So let's jump into it, guys. So what is cost segregation? It is basically having an engineering firm basically analyze and categorize building components into their proper tax life. Remember, we said the word tax life is either 5 years, 15 years, or 39 years if it's commercial. If it's multifamily or if it's an apartment, it's 27.5 years. That's what's called straight line depreciation. When you do not choose to accelerate the building components, you're just saying, hey, I'm willing to take this $100 million hospital that I built, and I'm okay if you give this to me over a 39-year period. That's called straight line. That's called just kind of it's a default. It just happens automatically. So my point is, you have to be proactive in pursuing tax benefits. Okay. Now we're going to look at these buckets. Remember, we talked about tax lives. They're buckets. Okay. So if you're taking notes, all building components are into a 5-year tax bucket, a 7-year, which is not very often, a 15-year, and then it's either 27.5 if it's residential, multifamily, or long-term, normally. And then commercial is going to be 39 years. Okay. We're going to keep going a little bit deeper. So now let's talk about these buckets, these buckets of building components. Okay. On the far left side, these are building components that you cannot accelerate. So think about it like this. We can't get a tax benefit out of the 27 and 39. What the tax law says is any building component that has a 20-year tax life or less can be accelerated. So let's look at the left-hand side. structural, foundation, walls, some types of doors, windows, plumbing, electrical, building systems. Those are things that cannot be accelerated. The 5 year are things that can be. The 15 years are things that can be. So, note to self not to get too deep into the weeds. What we're saying is in a cost segregation study, we're just saying, can you have your construction engineer categorize what building components fall into what tax life, give it a value, and then you can have a proposal and you can see the reality of, hey, if I choose to take 20% of my depreciation now, yes, I'm not going to have it. Now I'm only going to have 80% to depreciate. But in reality, it's about time value of money. You know, if you could take 20% of your depreciation now, what could you do with that? Because that's the reality of, you don't have to use the tax savings from a cost segregation. You can buy it for, you can buy a boat, you can buy a car, but in reality, the major purpose for cost segregation is to free up taxes, free up cash flow from tax savings. So for example, if we could free up $200,000 to offset your income, and if you're at a 30% tax bracket, what is it, $60,000 that you now get to save? Well, maybe you're going to use that 60,000 for another down payment on the next property. So that's really the focal point of a cost segregation study, is to free up cash flow so you can continue to grow your business every single year. Now, I think that's where the hiccup is with the CPA, to be bluntly honest. I think their rationale is the following. Okay, Chris, you built a relationship with my client. Yeah, they understand that on $1 million property, we can accelerate 200,000 or 20% of $1 million. But now, Chris, they only have 80% depreciation for the next, let's say 38 years. But what I say to the CPA is, come on, this client is an entrepreneur. We have to be willing to ask them, if we could free up a $200,000 tax benefit at 30% tax bracket, if we could free up 60 grand, would you want to make a down payment on another property? I think what happens is the average person, because they don't have someone like me to encourage them to go buy another property, they end up just spending it. And so the CPA is kind of like, well, hang on, great. Yeah, you help them buy a boat. Yeah, you help them save 60 grand. But now they have 80%. Now they've lost 20% of their depreciation. And what I'd say as an entrepreneur, that's a business decision. What would you do with 60 grand? Would you rather the IRS hold your 60 grand for 39 years? That's all you're saying. Would you rather the IRS hold it for 39 years, or would you rather take it? And there's a one-time small fee, one time, to be able to take it now versus having the IRS give it to you for 39 years. Okay? And this is a real simple slide. And all this really is if you're taking notes, remember what I said, the word straight line depreciation. Straight line means I'm just gonna accept the default. I spend $1 million in construction cost, and I'm building an office complex. I'm willing to, if my construction cost is $1 million, if I take $1 million divided by 39, every single year I'm going to get that depreciation expense. It's called straight line depreciation. Or you can do what the tax law allows you to do. And what will they say is you pay a cost segregation firm one time, and they will accelerate every bit of the building components that have a 20-year tax life or less. And then you can take it in the very first year if you want. It's all about planning. It's all about freeing up cash flow so you can buy another property. Because when you buy another property, you're going to do another cost segregation. So you can only do one cost segregation study in one ownership. So if you only own one property, you can only do one cost segregation study. But here's the good news. But as you start to do improvements, remember, a depreciation schedule has a life. Every single year, you're adding to your depreciation. So let's just say in 5 years, on $1 million, let's say you end up spending 120 grand. on whatever that might be in improvements. Well, now you can study the improvements. So it's an ongoing thing. Normally, I would tell someone you don't want to, it's not cost prohibitive unless you at least spend $50,000 of improvements. But here's another thing what I've learned. This is really truly about your tax bracket. Because if you're in a 15% tax bracket, not that big of a benefit. But when you start to get into the 20s, the 30s, and the upper 30s, it's a big difference. It's, do I want to pay taxes cents on a dollar, or do I want to pay taxes dollar for dollar? Now, this is definitely probably one of the most important parts of this talk, is if y'all could take notes on this. Any property that was placed in service, think about when you started renting it out, between 2018, actually it's late 2017, but let's just say for easy numbers, 2018 to the end of December of 2022. So let's just say from January of 2018 to December 31st of 2022, those properties qualify for 100% bonus. What does that mean? It means that you can take 100, whatever we can accelerate, the building components that fall in 20-year tax life or less can be accelerated. If you place the property in service from, once again, 2018 to December 31st of 2022, you get 100% of that. Okay? Now in 2023, remember, this is all about placed in service date. When did you start renting it out? If you place the property in service in 2023, you can only bonus 80% of what can be accelerated. In 2024, it's 60% of what can be accelerated. The good news is, regardless if you like Donald Trump or not, he's the reason for bonus. He's the reason what brought bonus back. So if you watched him on TV, he's being quite aggressive. There's got to be a 99.9% chance that this tax law that he put in place back in 2017, the way it's set up right now is when the law does get passed, which could be in a month, 2 months, 4 months, 6 months, it's going to go back to 100%. So note to self, it's very important that cost segregation works on properties that are for new construction, an existing building that you bought because it's new to you, it's a new owner, on renovations that you've made. So it's really important that you understand that even though there was a property back in 2018, 2019, 2020, you do not, a lot of CPAs don't know this, you can go study a property that you've already filed taxes on. So when you placed a property in service in 2020, the average person's like, I don't want to go back and amend my return for 2020. You don't have to. It's something called a 3115 form. And all it's saying is, IRS, I didn't know about cost segregation study back in 2019, 2020, 2021, maybe not even in 2023. I don't want to amend my return, but I do want to go back to 2018 and make an adjustment in my depreciation schedule so I can go take the acceleration that I did not take. So remember, there's no amending of a return. A lot of CPAs don't know this. So remember that this does not, it's not, you didn't lose it. Just because you didn't study it back to, I did one on a property today, it was back in 2014. No amending, just needs a 3115. Now, these are things that we educate your CPA and we make sure that everybody's on the same page. I don't think this is going to apply for much longer, but in reality, because they look at the very bottom, this was obviously made right before the new president. Bonus will likely continue to decline unless Congress makes a change. This is not expected until after the next presidential election. Well, that's obviously happened, recently. So I'd have to believe that any property that you're going to buy in 2025, we're going to know way before you file your taxes if the law got changed. So just know that. But I want you to know that even if the law doesn't change, you can still study your properties that you placed in service from 2018 to the end of 2022, and you still get 100% bonus. For 2023, 80. For 2024, 60. But in reality, I think before you file your 2025 taxes, it's going to go back to 100. And we just cross that road when we get there. Okay. Now, this is something that I want to make sure that everybody gets also here. Okay. Who is the one benefiting from a cost segregation study? Remember, it's recently purchased property, newly constructed, also what's called a tenant improvement is if you're occupying a property, but you don't own it, but you're having to spend money. Well, you're able to do a cost segregation study on a property that you don't own, but you're making tenant improvements. That you're saying, hey, I don't own this property, but I'm spending 400 grand to get it to where it needs to be so it works for my business. This is also an incredible estate planning tool. I was talking to somebody yesterday, and I actually didn't believe it was true. I was like, how have I not thought about that? Is literally from an estate planning, you can literally take all the acceleration, whatever the tax law allows you to. And when you pass away, your kids get a step up in basis. And then all of a sudden they get to do another cost segregation study. Another thing that someone brought up to me I thought was really very interesting. And I'll get into that a little bit later. It might be a little complex. But this is just a perfect example of straight line depreciation. Remember, straight line is just taking the 1 million and divided over 39 years. It's called straight line. You get your depreciation every year. Then you can accelerate your depreciation. And that's saying, hey, if I pay you in your firm and we can find, let's say, 20 to 25% of this million that can be in a 5-year or 15-year, then we can accelerate it over 5 years or 15, or you can bonus it. So just know you very much can tailor make this to whatever your certain situation is, so it's beneficial for you. This slide really is just to give you an idea that what I want you to think about is a rental property. It can be a residential long-term rental. It can be a short-term rental. It can be a hotel, motel. It can be an industrial building. Any building that is rented out qualifies for a cost segregation study. Okay. This is literally any property that's being rented out. Now, obviously you can't, now even your residential property, if you're in some great place where you can do a short-term rental that everybody wants to come to your part of, your town. I have a ton of clients that literally, this is just what they do, is they have a small part of their property is Airbnb. Well, that part of it that's being rented out as a short-term rental, you can actually do a cost segregation study on that. So just know you can actually be at a location, but as long as you're renting, I have a lot of clients that do like these little tiny homes or called ADU units, where basically they have their own property, but they're building like they have maybe some acreage where they can build little not smart homes, but little tiny homes, little 800 square foot houses they can rent out. Well, you can't study your primary residence, but you can study the portion of it that's rented if you're renting out a portion of your property. Okay. This is something I definitely want everybody to pick up their pen for, because I think this is the most overlooked circumstance that CPAs, there's no way a CPA is letting you know about this because there's no way they know. They do not know when you're doing demolition. So what I want you to know is any property that you've placed in service, remember, it's rented out. If you're going to do any renovations whatsoever, you want to call someone like me first, because on a property that's placed in service, remember, it's being rented, then all of a sudden you have to do work on it. If we can come out there first and take pictures before you do the renovations, you actually get a deduction You get to expense whatever you're throwing away. It is something that I see so many people miss, because how is a CPA going to know that you're doing renovations? They find out after. They find out after when they go, hey, we're doing our taxes. Wait, did you spend any money this year on your rental property? Yeah, we spent 100 grand. What's too late? It's already done. So we have to get in there before you do the renovations. Then you get an actual additional deduction for actually throwing away assets. So that's really important. It's called repair regulations, or called partial asset disposition. This is just another example, nothing too pivotal. This is where I want to spend a little bit of time. Is I can tell you this, 60% of my business comes from CPAs. So I'm the first one to say, thank you, CPA. Thank you for your business. Thank you for your referrals. Thank you for your trust. But let me tell you where CPAs are really struggling. I'm going to tell you, if there's a reason why you haven't heard about it, I'm going to tell you why. Okay. So here, if you're taking notes, why I haven't heard about this, I'll give you the reasons. The first reason is a CPA is not interested in selling you anything. They're not normally the most extroverted people, and they want to have the shortest conversation they can possibly have with you to do their job, because they got 1,000 things to do. So in rationale, here's the first reason. When I bring this up to a CPA, here's exactly what happens every single time. I mean, I don't think it's ever not happened. Let's use the example of a $1 million construction cost. $1 million construction cost. CPA, on this $1 million construction, we can accelerate about almost $250,000 of this $1 million. So this client can actually take $250,000 of the depreciation to offset either their passive or their active income for 2024 taxes. And this is what I hear from a CPA. And this is God as my witness. This is what they'll say to the client. Jimmy, you know you're going to get this depreciation anyway. And the client goes, what do you mean? Well, you know this $1 million that you paid for this construction of this property, the IRS is going to let you take it. They're going to let you take it every year for the next 39 years. And the client goes, but it takes me 39 years. And the client goes, yeah. The CPA goes, yeah. So the client goes, wait, so you're saying that I can pay, let's say, $5,000 one time, and I can take $250,000 of that depreciation right now? I don't have to take it over 39 years? CPA goes, yeah. I mean, if you want to pay for it, you can. It's really like that. It's like such a rhetorical question, but that's the way their brains work. They look at it in such a way of, you're going to get it anyway. And remember how I shared a little bit earlier? Is let's say that we end up accelerating 250,000 of the $1 million. In their brain, the way it works is, yeah, Chris, but if they don't use that tax savings to go buy another property, you just took 25% of their depreciation. Yeah, you made a new client, but now they only have 75% of their depreciation left. And so what I'm telling the client is, hey, he's right. Yes, I know we like to save taxes, but if you could take that $200,000 savings at a 30% tax bracket, you could take that $60,000, just go put a down payment on another property. That's all they want to hear. That's what a CPA wants to hear, is that we're not just taking $250,000 of your depreciation and now you have $250,000 less. But as an entrepreneur, that's a business decision, not a tax decision. So that's really important to understand. That's why your CPA is basically not bringing this to your attention, or if you haven't heard about it, because they're like, he's going to get it anyway. They're not trying to sell you on anything. I'm just saying, if you could save $60,000 now, would you want to do that? Or would you rather the IRS give you that $60,000 over 39 years? You pay a one-time fee of $5,000 to get it now. That's just a business decision. So that's one of the main reasons. The next thing is, oh, my CPA is taking care of it. What a CPA will do is, remember, they're not construction engineers and they're not appraisers. They will take a handful of building components that are easy to classify, and they might accelerate some of them. But in reality, this is about optimization. So I would say the same thing with the CPA that I just got on the phone with, is the client, excuse me, the CPA did take a handful. On $1 million building, he accelerated about 60,000. He did. So he did. So I did accelerate it. My CPA did take care of it. So my CPA took care of it for me. He accelerated about 60,000. And I said, well, can I see that depreciation schedule? We end up doing an analysis, and we're able to pick up, they got 60, but we were able to get 220,000. So what I told the client, are you willing to spend $4,500 to get that additional $170,000 of deduction? The answer was yes, of course I am. Of course I would. But in reality, their CPA had already taken care of it. So that's what's very important, is you cannot just assume your CPA is taking care of it. They're worn out. They don't have the time nor the energy to dig very deep. So you have to be willing to say, hey, let me get a proposal. Let me look at the truth. Then we can have a discussion. But just to say my CPA's got taken care of, I can tell you this, they don't. That's not what they do. Now, if you're with a major big five firm, and let's say you're spending $30,000 a year on taxes, on your tax return, then they might have an internal cost segregation firm. But that is so rare. If you're not spending at least 25 grand, I guarantee you they don't have an internal cost segregation firm. So just note to self, those are two major reasons why a CPA is going, it's not really my job to sell them on this. Because once again, there's a cost to it. And remember, in their mind, they're thinking you're going to get this anyway. And so that's the reason why, sadly, 9 out of 10 CPAs don't even own real estate. But they see us saving taxes all day long. I don't know why. You would think they would be the first persons out there buying rental properties because they understand the tax law. But hey, that's why we have to keep digging deeper. Okay. Here's another issue. Golly, is this going to trigger an audit? Now, this is from the journal, I can't say this right, Accountancy. The cost segregation technique is no more aggressive than using regular straight line depreciation. Remember like this, if we've done 47,000 studies and we've been audited 22 times. Every of those 22, we passed. The client did not have to pay any additional taxes. This is not about triggering an audit. This is about it's no different than when your CPA says, can you tell me how many miles you, if you're a real estate person, or if you're self-employed, or if you have your own business, hey, can you tell me what did you spend in meal deductions or your mileage deductions? What does that trigger an audit? No, that's just the tax law. So we're just trying to implement the tax law. And I can tell you this, if we've done 47,000 and we've only been audited 22 times, obviously cost segregation is not high on the list, because they know that we're the first cost segregation firm in the United States. So our boss, a guy named Jim Shreve, the founder, was the one that actually was involved with the IRS and kind of setting the procedures and protocols to make the laws valid. So we were a part of that because we were one of the first people in that industry. How do we get started? Really, it's really based upon very easy things like type of building. I'm going to look up the land value. What was the year that you placed it in service? And what is the address? Not a big deal at all whatsoever. I think that I want to make sure is my job is to spend time with a CPA. My job, like I literally have never, not one time in 6 years, have I ever done cost segregation study without a CPA's approval. So remember, you don't know me. You're getting to know me, and obviously Kendall and Don, they built that credibility. But just know your CPA, you will get that approval. My job is just to make sure that it's optimized. That's my job. So once again, this applies to new purchases, new construction, buildings that you've owned for many years. Remember, we don't have to go amend our return. We do a 3115 that allows us to go back and get acceleration we didn't take. And if you're making improvements of at least 50,000 or more, okay? Who is our company? Just what I shared before. We have actually been in business now for 22 years. We've done over 47,000 studies. And our boss was the one, founder Jim Shreve, was the one that literally was involved in the procedures and protocols in making cost segregation legal. So you can know that every IRS agent knows who we are. We're like the oldest cost segregation firm in the United States. So why would you really want to track down and spend a lot of time with a company that helped build the protocols for the tax law? So, we're not a small firm. I think probably the next firm has maybe done 30, 32. So we're still, we're one of the largest firms out there. Now, this is something that might be a little bit out of the norm. So this only applies to a building that's at least $10 million. So this is not going to be, this is a niche. This is a niche. But if you have purchased or if you've built a building over $10 million, what we'd have is something called, this might be a little confusing, but remember we talked about cost segregation is about finding the building components that have a 5-year, a 7-year, a 15-year, or even 20-year tax life that we can accelerate it. Well, we have an application that we're the only person in the United States that has this, that we're approved by the IRS, that I know this is not what you guys do every day, so I'm not going to bore you with it, but by applying this tape to drywall, it allows the walls, non-load bearing walls, to be movable. So why would you care about that? Well, if a wall is movable, it becomes a 5-year building component. All walls, non-load bearing walls, are 39 and 27.5. You cannot accelerate them. But if you use a product that we offer exclusively, you're now able to make a building component that was 39 year or 27, you're able to make it 5. So why would the IRS, why would they allow you to make a building component a movable wall if you don't plan on moving it? Well, first of all, we don't know if you're going to move it, but 18% of all of the demolition in the all the landfills, 18% of all the landfills are sheetrock demolition. So the IRS is basically saying, hey, listen, if you're going to be willing to use this application, we know you're never going to knock down walls because you've applied the tape and you can make a wall movable. So that's something called green zip tape. It really is only going to come into play for new construction, because remember, we have to place the tape before the sheetrock goes up. So new construction and renovations. So think about it like this: a $10 million new building or $10 million in renovations. Well, I know it's very much a niche, but we're the only company in the United States that offers this product. So it's very important because it's not being really promoted. So $10 million and up for new construction or renovations, it allows you to double your cost segregation because you're making walls that were 39, you're moving them into 5-year because we're making walls movable. So I'm not going to get much deeper into that. Just know this: put the word green zip tape, new construction, $10 million, or renovations of 10 million. If you're doing either one of those, just call me and at least I can go a little deeper with you on that. And really, the green zip really is about being environmentally friendly, but there's no doubt it allows your building components, that those non-load bearing walls, it allows them to become 5-year, and we have all the IRS documentation. We have every single thing for your CPA to know that we've been doing that for almost 15 years. and we've been audited. It's passed all the sniff tests. So, just note to self, just write that $10 million number down. If that ever applies, just know that we'd love to give you a quote on that. Okay. Now we're going to go into something a little bit different. Oop, I lost me. Sorry about that, guys. What is a 179D? This is another product. So we have Green Zip. It's for the $10 million construction or $10 million renovation. We have cost segregation that I would say any property that has a cost basis of $200,000 of higher. So remember, for cost segregation, a cost basis of $200,000 or higher, or improvements of at least $50,000. Okay. So for a section 179, it's on any building. We've done the numbers. It needs to be at least 40,000 square feet. So if you have buildings that are at least 42,000 square feet, now it's basically an energy. It's basically right here. It says the 179 energy efficient commercial building tax deduction, also known as the energy efficient commercial building deduction. It's basically when you're being tax friendly from forms of roofing to HVAC to electricity to insulation, things of that nature. Lighting, HVAC, hot water, building envelope, like the roof, the windows, the insulation. So here's the point. Everybody is going to, what I'd say, not be approved, but it's literally impossible to build a property in the last 10 years and not qualify for this. It's just, have you ever got a quote? Do you have a property that's 40,000 square feet? So I would say that would be one of the things. Do you have a property that's 40,000 square feet? Well, if you do, then we need to get you a quote so you can have an understanding of what the tax benefits are. So that's kind of, once again, cost segregation, minimum of $200,000 cost basis or $50,000 improvements, Green Zip, at least a $10 million new construction or $10 million improvement. Now let's talk about the section 179, energy efficiency. It's going to be at least a property that's at least 42,000 square feet. That normally that's when the numbers really start to work. So I really just kind of want to leave it up to questions right now in any way that Kendall wants to take it over from here. So where do we go from here, Kendall?
Chris, awesome information. Seriously, I loved that. Seriously, learned a lot myself. Things I didn't know. We've done this a couple times now, and there's some nuances that I wasn't aware of. That's pretty cool.
Yeah.
Thank you so much. So, okay, so if someone wants to get started with you, I know we have a lot of investors in real estate. If someone wants to get started, what's the best way for them to do that?
Yeah, I mean, I would definitely say, I'm going to go back to my very top, just so you have my information. It's right here. Is you maybe take a snapshot of it on your phone, or write that down. But I would really truly say that if there's nothing more that you picked up from this meeting is you can't say my CPA is taking care of it. It's not happening. It's just not
Yeah.
happening. Even when they do, I'll say, give me your depreciation schedule, because they've only picked a handful. They're doing their job. They're saying, hey, yeah, I'm doing my job. But reality is remember, it's about optimization. So that's really the goal. My goal is to get a proposal in your hand so you can see the truth. Then you can determine if if it makes sense for you, because there's one thing I would say about cost segregation. This is another thing to really maybe put your notes. Cost segregation does not make sense on a property that you're not planning to hold for at least 2 to 3 years. So if
Love
you're a
that.
flipper of properties, don't waste your time. But
Love
if you're
that.
holding it for at least 2 to 3 years, then we can have a discussion and I can explain to you some of the pros and cons. What were you saying, Kendall? Forgive me.
No, I love that. That's fantastic because if you're holding the property longer, it makes a lot of sense. And I think you're absolutely right with this new administration. I think we're going to see a lot more. Trump's a real estate investor. We're going to see a lot more
He's going to have to
coming down the
file his
pipeline.
taxes very soon. So that's why I'm like, this law's got to pass pretty soon. I'm sure he's like me. I have K1, so I'm probably always filing extensions. But, that's really what I want to make sure that everybody, understands is, this is every person's situation is different. And
Yeah.
so it's like, hey, are you a passive investor? Are you a real estate professional? One thing I would say out there that if I'm sure everybody's heard about the short-term rental. Please note that a short-term rental is 39 years. It's not 27.5. It's a commercial. It's not residential. But it's really important. If you have a short-term rental and you have not looked at a cost segregation study, you have to give me a call because literally you only have to do 100 hours of material participation
Oh, easy.
for the tax benefit to go against your total income. A motel, hotel, and short-term rental are the only three properties that qualify for only needing 100 hours of material participation for it to go against your total income.
Didn't know
Every
that.
other property other than those three, you have to be considered a real estate professional for it to go against your total income. So short-term rental is a very, very, very unique situation. Another thing I would throw out there, which is very, very unique, is whenever you have owner occupied, if you're going to buy a property where you're going to run your business from that property and you're the only place, it's called common and equal ownership. So if you and your spouse own the rental property, and let's just say you own the operations, like you run an engineering firm out of a property you bought, you have to call me before you file your taxes because if you have an owner occupied property and you do the cost segregation in the same year you're renting the property, the first year, you're able to use it against your total income. But here's the hard
Wow.
part. Let's just say that you're a dentist and you just bought a property, and you're the owner of the dental practice and you also own the property. But let's say that they bought the property in 2024 and they started to operating their business in 2024 and they filed their taxes for 2024. Because they didn't do the cost segregation in the same tax year, now the cost segregation only goes against their passive income.
Oh.
So here's the problem. Your CPA doesn't know that you bought a property until after you bought the property.
Wow.
So it's really, really important that if you, like, perfect example is for individuals that are in the assisted living facilities, because they're buying a property and they're running their business from that property. If they do that cost segregation in that first year, they can use the cost segregation to offset their total income without them being a real estate professional. It's very, very unique, but it's got to be done in the first year. So that's why I would say if you are buying a property or you have a property that you haven't studied, let me just give you a proposal so you can take it to your CPA, because that's what I see missed a lot is that first year that residential, let's say somebody says, hey, I want to establish, forgive me, I'm going blank, the residential assisted living.
Yeah.
Is they're like, but I'm not a real estate professional. But if you're running a business from that property, then now the cost segregation goes against your total income. But if you filed your taxes and you called me in 2025, it only goes against your passive. That's a big difference. So
Wow.
there's a lot of things that just people, you got to find out before you file your taxes. That's the key.
So it's like we always say, what you don't know can hurt you, especially when it comes to taxes. What you don't know can hurt you. So that's where tax planning versus tax preparation is
Yeah.
a wide difference. You need professionals like Chris and his team guys, I totally recommend you contact Chris if you're involved in real estate, short term, long term. There's definitely contact Chris. I love that, Chris. Seriously, thank you for sharing.
My
And one
pleasure,
thing I
bud.
will say is, a lot of our students, we are very good educators. And a lot of times we teach detail on different tax and legal strategies. But here's the thing, guys. You don't have to know every little nuance of this. That's what Chris and his team does. I personally don't want to know the engineering details of what qualifies, what doesn't qualify, how many years, things like that. It's good to know occasionally, right? It's just the details of when to file taxes. I have this many properties. Should I file now or later?
Yeah.
That's where you come in, Chris, and that's tax planning versus tax preparation. Wide difference. I love
It
that.
takes a team. It definitely does take a team. That's why I love what you guys are doing. You're making it very simple for the average person, to be able to get ways of sheltering assets, ways of protecting yourself from lawsuits. I mean, life happens.
You have
Taxes
to do
happen.
it. Yeah, you have to
So
do it. You
it's
do.
a great opportunity. Thank you for allowing me to be here.
Yeah, let's see. We got several questions in here, Chris, and I think you answered a few, but let's jump into it if you okay. If you got a few minutes.
Yeah,
Uh,
please.
Mohammed, you covered this one a little bit. Do you have to have a real estate professional status to benefit from cost seg and
Great.
yeah,
Great question. Great question. Very good question. So remember, think about what a cost segregation study does. It accelerates the building components. So now let's use the $1 million. $1 million, we can accelerate, let's just say 20%. So that's 200,000. So who can take that acceleration? Number one, if it's a short-term rental, you only have to materially participate 100 hours. Now you can take that 200,000 against your total income. If you're married, it's against you and your spouse. So please forgive me. What was the person's name that shared the question?
Mohammed.
Muhammad. So Muhammad, in your brain, it's like you for a short-term rental, it's like you're a real estate professional. Instead of doing 750 hours, you only have to do 100. The next person is, hey, it's not a short-term rental, Chris. It's multifamily or it's a industrial plex. If you're not a real estate professional, what is a real estate professional anyway? It's someone that expends at least 750 hours a year in their real estate business. That's what a real estate professional is. You can be a dental hygienist and be a real estate professional. It's about the 750 hours. So we have three different people. We have if you're a short-term rental, are you bought a motel or a hotel? That's considered a commercial. So now if you spend 100 hours, you're able to take the 200,000 against your total income. If it's not a short-term rental, motel or hotel, and you're not a real estate professional, it still offsets your passive income.
Oh.
So hopefully, why would you buy rental property unless you have passive income? I don't think you did it just to break even. So
100 hours is a pretty low threshold. That's
it's
amazing. I didn't know
nothing.
that.
I have doctors that are spending 80 hours a week that are buying short-term rentals like 4 a year.
Cool. That's cool.
So that's the important thing. Short-term rental, motel, hotel, 100 hours allows you to take it against your total income. If you're a real estate professional and you're spending 750 hours, then it gets to go against your what? Total income. If you're not a real estate professional and this is not a short-term motel, hotel, it still goes against your passive income. The
That's
difference
cool.
is that when passive, you just can't take it in the first year. It might take you 5 years, but who cares? Because it's not like passive income has a separate tax bracket. Your passive income gets thrown on your ordinary income.
Yeah.
So in reality is let's just say that you say, Chris, I only have $30,000 of net income that I pay taxes on. But Chris, you're giving me a $200,000 benefit. Well, guess what? The next $200,000 of rental income, you won't pay taxes. It
Beautiful.
just might take 6 years for you to get it.
I
You
love
still
it.
get it. It's
See,
just not as fast.
that's where the math comes in. This is where wealth is created in real estate right there. That's it.
Yeah.
That's it. I
Just,
love that.
just
All
taking
right.
that 200,000 and divided by 30, and what is that? 6 times 3, 180. Yeah,
That's
so
good.
it's about 6 years.
Perfect. Ah, beautiful. Okay. Jackie's asking a great question here. I love it. So, how is that accelerated depreciation dealt with when the property is sold? Will that hurt capital gains tax
Great
in the
question.
future from add back?
Great question. Great question. That's why I have never had a client ever be upset with me when they've held a property for 2 years. Now, why am I saying that? Because let's say this example of the $1 million property, and let's say it was $5,000. Okay. And let's say we did accelerate $200,000. And let's say you sold that property in the third year. You legitimately would probably give back of the 200, you'd probably give back about 175 or 180. But the point is, you only spent 5 grand. So the point is, it's about the net number. And then this is what I also would tell someone. Remember, there's a difference between capital gains and recapture tax. Recapture is whenever remember, you pay recapture no matter what when you sell a property. You can't get around that unless you're doing a 1031.
Right.
But if you held a property for 5 years, you can always 1031 and have no recapture. So that's really your question. Your question is, if I sell it before 5 years, I have something called recapture. But what I'm saying is, my way and your way to justify would be this. I'm about to spend $5,000. Do I believe that over a 2.5 year period that I'm going to be able to sell my property enough to justify a $5,000 fee? And I would say, if you're not going to make $5,000 more than what you have into the property, why are you selling it?
Right.
So
Totally
people
agree.
get caught up in that. But in reality, what I would say is, let's run the numbers.
Yeah.
Let me see what your tax bracket is. Because if you're in a 10 to 12% tax bracket, cost segregation doesn't even make sense for you anyway. Remember, this isn't a credit, it's a deduction. But if you're holding your property for at least 5 years and you're doing a 1031, you're not paying back any of it. But once again, this is a case by case basis.
Very cool. All right, that's a great answer. Okay, Simeon asks, can you do a cost seg on a new roof valued at 36,000? The HOA replaced the roof from a rental property. The roof was a metal roof.
Well, here's the deal. When it comes to, I think that was that number 50. It's really has to everything to do with, was this a property that obviously you said replaced a roof? So the property was already in service. This is that partial asset disposition. Have you already replaced the roof? If you've already replaced the roof, then we're not able to take pictures before it, so you can't get a benefit for throwing it away. So I would say if you end up spending 30 something thousand and the roof is already done, it's not worth it's not worth the cost unless you're at the highest tax bracket. And I think 50,000 is really kind of the barrier of entry that
Oh,
starts to make sense.
see, this is really cool to know, guys. So it really does. Again, we go back to what you don't know can hurt you. Make sure you're talking to a tax professional, not just your local CPA who doesn't know about these strategies like Chris can tell you, because they, frankly, like Chris said, they don't tell you. So, Chris, again, your contact information's up here. I'm going to refer everybody back to you before we get to the rest of these questions. Definitely write down Chris's contact information. We work directly with Chris. Super excited about that opportunity to have Chris to work with, because clearly Chris is very knowledgeable. So we appreciate you sharing that. And Chris, you still got time for? We got
Yeah,
several
I'm
questions.
wide open. I've locked my kids in a room.
All right. Well, we got about 16 questions here. We'll bust through them if you're okay. Just get through them as best we can, guys. Anonymous says, when using green tape for the removal of walls, how does it impact compliance with building codes with walls? Are there changes to permits, construction drawings, things like that?
Well, once again, remember this is also a $10 million building. So remember this is big stuff. There's not, so what I would say initially is, remember, green zip has to do with new construction. We'd have to get in before the sheetrock. So this is not like an after thing. We'd have to be involved in the process, or if you're doing renovations, all it is a form of mesh tape that's been like the IRS probably had 10 or 12 different companies provide to try to get approved. Our tape was the only one that got approved. That basically, when you have the tape, like think about just a really nice piece of mesh tape. When you apply it, just like what a normal, a person that would do sheetrock, they have, dispensers that it's basically when you're ripping up the tape, all you're doing is you're just making the wall movable. But when you get into the compliance of it, I think it's just case by case. But I would definitely say yes, if you are in a construction, how about this? If you're building a building, it's at least $10 million and you have not put in the sheetrock, yeah, let's just have a conversation. Or if you're making a renovation of at least $10 million and you haven't put in the sheetrock, let's have a conversation about that.
So a lot of you need to have a conversation with Chris. I love it. Okay, Brian's asking, I have 5 single-family homes I bought for around 120 each in 2020 that I plan to hold for at least 5 more years. Does cost seg make sense? Cost seg makes sense for me.
I think it's a great question. It boils down to 2 ways. So remember, this is not a short term. It's not a mobile. It's not a short term. It's not a hotel. It's not a motel. So this is going to be over 27.5 years. Okay. My question to the person that just asked that is, are you a real estate professional? Are you married to a real estate professional? If not, this is only going to offset your passive income. And what I've seen, is normally on a long-term rental, normally the straight line depreciation normally is enough to offset the income. So I'm gonna give it for example. On this 120,000, I think 120,000 he said.
120,000, 5 properties, and he is saying that he is a real estate professional.
Then that's ding ding, check check. That when you get real estate professional, you kind of hit the holy of holies. Like if you're in real estate professional and you're not doing cost segregation, I don't even know what we're even like. That's like 101.
That's cool.
So yeah, it's 100% for you. If you weren't a real estate professional, I'm gonna try to answer that question.
Chris, Brian, Chris, your new best friend sounds like.
So if we take 120,000 and we divide that by 27.5 years, that would mean your depreciation that you get remember, it's free. Your straight line depreciation is just like default. Remember, I took 120 divided by 27.5 is 4,363. Normally, you would know because you have that rental property, you're probably not, unless you've paid off your property, you're not probably netting $4,300 a year on a $120,000 property. So you wouldn't need a cost segregation study. Why? Because your automatic depreciation of $4,300 offsets your $4,300 of passive income. But if you're a real estate professional and you got 120,000 times 5, that's 600,000, and you take 20% of that, now you got $120,000. So yeah, if you're a real estate professional, you've already checked the box. But if you're not a real estate professional, all you got to do is this. Look at your straight line depreciation. All you do is just look on your depreciation schedule, or call me, I'll do it for free. You take your building cost, divided by 27.5 or 39. That number automatically offsets whatever your net rental income. Most people are not making more money on a long-term rental more than what their depreciation schedule gives them for free.
Brian says he nets more than 14K. So Brian, it sounds like you need to call Chris.
He's paid his house off.
There you go, buddy.
He's paid his house off. There's no way he can net 14 grand on a $120,000 house. Impossible.
These kind of see, and Brian, this will be huge for you. You know, you may or may not be doing a lot of strategies, but I'll tell you what, Chris has just upped your game a lot, and you should be buying new properties, more properties.
It's just looking at the facts, looking at the numbers, looking at the pros and cons. And I got to sleep well at night too. I'm all about, hey, I might not be able to help you. Just like if the person that has 5 $120,000 houses, if you are not a real estate investor, there's a 99% chance you don't need me. Because you're what? Because your passive income Because if you're not a real estate professional, it only offsets your passive income. And
That's
your
cool.
straight line depreciation offset that.
That's cool.
But the
I
fact
love it.
that you're making $14,000 per property, yeah, you got some paid off houses, my friend.
It's got to feel good doing this every day, Chris. You're helping people find money every single day that they didn't know they had. That's cool. I love that.
Yeah, it is fun. It's exciting. I'm grateful for the opportunity.
Us too. How does cost segregation apply to rooming homes or student housing?
No different. Remember, it's a property that's being rented out. If you own a property and you're renting it, it qualifies for a cost segregation study. So if it's multifamily, it's student housing, if you have someone that's paying you money, then it qualifies for a cost segregation study.
Okay,
Someone's
great.
paying you rent on a property you own, it qualifies.
Okay. All right, great question here. Mark's asking, I had a cost seg done in 2023 that had a picture of the property the same year the property was put into service. In 2024, did a lot of renovation to the tune of 60 grand, roof upgrade, HVAC. Can I benefit from a partial asset disposition?
If you haven't already done the renovation.
See, that's the question.
Remember, we
Yep.
got to get in there before you rip everything out.
And that's the thing that this again, Mark. Chris talked about this beforehand. So before you do renovation, guys, if you're investing in real estate, call Chris. There might be some
Before
massive
you
benefit.
rip things up, because we can actually get you a deduction for assets that you're throwing away. Like, let's say it's a roof, might get a $12,000 deduction for it. You're throwing away an HVAC, you might get a $6,000 deduction for it. But this has to happen before you do it, not after you do it.
So cool. Okay. All right. What if I buy a new property and sell the old property? Can you use cost seg against total income?
Okay, say that one more time.
If you buy a new property and sell your old property, can you then use cost seg against total income?
Yes. And let me make sure what you're saying. What I'm assuming is you're saying I have a property, I sold it. So I have a tax obligation, but I bought a new property. Remember, you only can do a cost segregation study on a property that you presently own, not on one that's sold. But
So
you
it's not a
can,
1031, guys. Yeah, it's different. Yeah.
yeah, only on a property that you still own. But let's say in 2023 you sold a property and you got some gains to pay for it, some ordinary income, or even capital gains. Who knows? If you held it for more than 1 year, you only have capital gains. If you do a study on a new property, that property can offset the gains. It really falls down to is, are you a passive? Are you a real estate professional?
Huh.
And I would
Very
love
cool.
to coach anybody that's got at least 4 properties. I'd love to coach you on how to have a conversation with your CPA so they will approve you as a real estate professional. Because remember, it's your CPA. It's nothing more than like on my tax return, it says Chris Danton, real estate professional. It's just a qualification that you're basically telling your CPA. This is what you're telling your CPA. Now, if you're a W-2 employee, very hard to qualify for a real estate professional. But if you have a spouse that's not a W-2 and you own multiple properties, it's justifiable to say that you could spend 750 hours. And remember, if you're married, it can be 750 hours split 2 ways. So what I would say is if you have multiple properties and you're not a real estate professional and you're not a W-2 employee and your wife or your spouse is, how about this? If you're not a real estate professional and you own, let's say, 3 or more properties, and neither you nor your spouse are a W-2 employee, I can show you, educate you on the conversation that you can have with your CPA that will convince them that you can qualify as a real estate professional. That's when everything changes. That's the game changer right there, is being able
Chris,
to understand that.
would you clarify one thing that
Mhm.
these properties that you own cannot be in IRAs?
Oh, 100%. Yes. If it's a
Okay.
self-directed IRA, remember, it's all pre-taxed. So an IRA, any type of self-directed IRA for real estate, there's no benefit from a cost segregation study because why? in a self-directed IRA, when it owns real estate, you're not paying taxes anyway. So
Yes.
yes, if you own real estate in an IRA, cost segregation will be of zero value to you.
Yeah. I mean, do both, right? I mean, it's interesting talking to our tax advisors. A lot of them do both, right? You want to have some in your IRA, some without,
Yeah,
right?
I'm
So,
just saying from a cost segregation
yeah,
standpoint, you can't do a cost segregation on an asset that's already pre-taxed.
makes no sense. Yeah,
Yeah.
yeah. Okay, how about properties and trust? Can the owners use cost
Mhm.
segregation?
100%. It's just, it also flows through to whatever the tax bracket of the trust is.
So, like
Yeah.
trusts, LLCs,
Yeah.
corporations,
Yeah, because
however you're
remember,
doing it,
most
right?
things are just pass-throughs. So in reality is any how about this? Any entity, any LLC, any trust, any sole proprietor, any individual that owns a property that has somebody renting from them qualifies for cost segregation and can benefit.
Okay.
So yes,
Excuse me.
trusts that own properties absolutely can benefit.
Okay, all right. Carmen asked, how short is a short-term rental in terms of months? What's considered a short-term rental, I guess, is the
Well,
question.
there's a couple things. The first one is you have to be willing that's not a vacation rental. You can't be spending more than 14 days a year. So that's number one. And then next is normally it needs to be less than 6 to 7 days. So the average stay. So it can't be like the average stay can't be 10 to 15 days. It can't be 2 weeks. It's got to work like a hotel or motel where it's people that are staying there for less than a week. And that's just average, you know? And once again, not many people can afford at short-term rental prices to stay more than 7 days, you
Yeah.
know? So that's kind of the criteria is, 6 or 7 days or less. And that you're not staying in that rental for more than 14 days a year.
Fascinating. Okay. All right. And Yanis is asking a good question. What tax changes, it's hard to speculate, but what tax changes do you anticipate will take place in the federal tax code, SALT cap increase, any insights on real estate property taxation improvements, things like that?
It's really tough
Yeah.
because, we got a new president that is doing some radical stuff. So what I would say that what I can say is what are the things that he already put in place in 2017 is bringing back the 100% bonus. Anything beyond that would be new tax law. He's just bringing back what he already did.
He's a
This
real
was
estate guy.
Yeah, he's just
Yeah.
bringing it back. Like this is not going to be a stretch for him to go, wait, why would I want my tax, law that I put in force in 2017 to fall away? I'm gonna,
Yeah.
of course, I'm gonna re-sign it. Of course, I'm not gonna let that happen. Now, on the new stuff, your guess is good as mine. Your
Yeah.
guess is good as mine. Because literally you have to take everything Donald Trump says with a grain of salt because he's not, there's nothing gray about him. It's black or white, and we will not know until the executive order is signed.
Black, white, or orange. And he's a real estate guy, right, guys? So that's a good thing.
Yeah, so trust me, when it
Yeah.
comes to real estate, you got to know it's going to be for
Good.
the benefit of
Very
real estate
much.
because
Very
he's a
much.
real estate guy.
All right. Mia's asking, does a mobile home park fit the concept in any way? Long-term rentals?
How about this? I almost didn't bring it up. The two most overlooked properties are RV parks and mobile home parks.
Really?
And people are like, what do you mean? Think about it like this. A mobile home literally only has a 5-year, surprisingly, according to the IRS, five-year tax life. So, and then every single thing on a mobile home park, everything are just land improvements, tie-ins, concrete slabs for the plumbing, the roads. So how about this? A mobile home park, let's just say the mobile home park, let's say you constructed it for $1 million, making that number up. constructed. Guess how much you can accelerate? $1 million.
Wow.
So literally on a regular property, I mean regular, let's say long-term rental, you can accelerate about 20%. For a mobile home park, you can accelerate 100.
I'd never know. That's amazing. I
It
never would
blew
have
me
guessed.
away. I was like, what the heck is going on here? And they're like, the only thing you can't accelerate is the land, but you can accelerate all the things within the land. Because think about when you're buying a park, what are you buying? You're buying what makes it a park.
Yeah.
And all of those things are what's called 15 years. There's nothing structural in a mobile home park. Whoever owns the mobile home park knows this. If you own the mobile homes, or how about this? Let's say you don't own the mobile homes. Then you've bought the park. So you own all of the tie-ins, you own all the hookups, you own the fences, the roads, the signage. So here's my point. If you own a mobile home park, cost segregation is 5 times better than any other property.
That's
Just no
cool.
one knows about it.
Well, you know what, guys, and we've had some webinars in the past on, believe it or not, Chris, on mobile home parks. Storage units, mobile home parks, things like that. Yeah, so that's,
I mean,
I have no
RV
idea.
parks and mobile home parks are 5 times a better rate of return than any other property owner. But here's the funny part.
Wow.
I've probably done, how about this? We've done 47,000 studies. We've done less than 300 mobile home parks.
Wow.
It's just either the industry doesn't know about it, or in their brain they're like, there's no building.
Yeah. Yeah.
There's no building. What are we? No, we're studying the mobile homes, and we're studying what's called the 15-year land improvements.
Wow.
It's all the things on your mobile home park because there's nothing structural. Nothing on a mobile home park is going to last more than 15 years.
Okay, Mia, sounds like you need to contact Chris too.
Yeah.
That's
Yeah, this gets, whenever I talk to mobile home park people, I get really excited.
Yeah, that's cool. And we do a lot of events in the past. We've had a lot of instructors that work with mobile home parks. Aaron Adams, does a lot of them. So guys, you're probably involved or at least thought about it. Okay, sounds like time to contact Chris.
And I think you guys probably know Frank and Dave of Mobile Home University.
Yeah.
I've been on their podcast multiple times. They're great guys.
Oh, that's cool. That's cool. All right. Everyone's pretty excited about that. Okay. All right. Okay. So a few questions back to the, if you had photos before and after roof replacement, does that count? Do photos count for anything?
It can. It can. I mean, it's definitely worth a conversation. It's really about looking at what your taxable income is. I mean, like what's your tax bracket? What's the cost of the study to get you a certain benefit? It's all going to be about a rate of return.
Okay, so we want to definitely contact Chris. Okay, and help me with this one, Chris. Teresa says, does a cost seg make sense for a QOZ property that becomes tax-free after holding it for 10 years?
A QOZ?
Qualified Opportunity Zone.
Oh, that's just capital gains.
Yeah.
Yeah, the capital gain. Yeah, 100%. As a matter of fact, I just did one on opportunity zones. Yeah, the only thing that separates an opportunity zone is when you sell it, you're not going to pay the gains.
Okay.
But other than that, 100% works for cost segregation studies.
Okay, and then Marilyn's asking how much is it cost generally for the service? That varies, I'm sure, depending on the properties, how many you're doing, the size, that sort of thing.
Yeah,
Any
it does vary.
insight?
I mean, I would say it can be anywhere between, on the very lowest end, it's going to be probably 2,500 to on the highest end, 20 grand.
Wow, that's cool. Right, and the question you have to ask, does the math work? How long are you going to hold it, Chris?
It's all
You
about the
addressed
rate.
this.
It's looking at the facts. It's like, I'm going to pay this much. Here's my deduction. Here's my tax bracket. Would I spend $4,000 to save 15? I don't know. Would you? These are questions you have to ask. Would you? I don't know. Some people say, well, yeah, why wouldn't I? Well, that's a good question. I got an easy job. I got a very easy job.
It's if it maths, absolutely. Okay. All right, Marilyn's asking, in what scenario would someone have a property in an IRA? You didn't know that was a thing, Marilyn. Absolutely, that's a thing, and we definitely recommend if you're not using your IRA to buy real estate, other items, things. It's called a self-directed IRA. Talk to us about that. Chris knows about that.
Yep,
I'm sure we
I
work with a
do.
lot of custodians. You can definitely do that. So if you're not, definitely consider it. But again, a cost seg study would not work for anything inside of an IRA.
Because it's already tax deferred. You're not paying taxes
Correct.
on it.
That's a beautiful thing. Okay, this goes back to that. What about properties owned in a Roth IRA that use leverage? Can you do cost segs on that to offset
Same
UDFI?
thing. It's all tax deferred. You're
Yeah.
not paying taxes on it. So you can't get a tax benefit from an asset you're not paying taxes on.
It's crazy. People are making a lot of comments about the mobile homes. Yeah. Yanis says rents are going up in mobile homes. Absolutely. We're all going to be living in one someday with the way rents are going. It's true.
Yeah, I mean, listen, and I always laugh because it's kind of like, I don't know if there's a higher rate of return on an
Wow.
investment than owning a mobile home park. If you can find somebody, no one just wants to be collecting the rent, but if you can find somebody that lives there that's already collecting your rent, hey, I mean, I always have my eyes open on it. I just happen to have a business partner that he's the boots on the ground. So he doesn't, I have to do what he says.
Well, and we mentioned Aaron Adams. A lot of you have worked with Aaron Adams. We've worked with Aaron for several years. He owns actually 3 different mobile home companies. And so he's done a lot of worked manufactured home, things like that. So it's a big deal. He owns a lot of parks. We've talked about this, guys. So definitely, it's something we cover. If you have questions, we have webinars on that too. Absolutely. People are asking, is it really something that's easy to rent out? Yeah, I think it is, guys. That's something we definitely cover. Sounds like Chris has experience with that too.
Yeah. Yeah. Because of the cost segregation being so outrageous, I've had to learn about it. I've had to learn, the ups and the downs and how to make a mobile home park, advantageous and where to look. And, as you remember, it's really important when you're buying a mobile home park is you don't want the land value to be really high.
Yeah.
Because the land you can't depreciate. So you want to kind of find a middle of America. And, you don't want to be in California. You don't want to be in, you don't want to have a mobile home park in a area where the land value is expensive.
Yeah. Makes sense. Okay, well, a lot of people are saying, Mia says, I'll be in touch, Chris. So a lot of people are saying they'll be in touch and reach out. Guys, absolutely, again, I can't stress enough, this is tax planning versus tax preparation. You want to contact Chris and strategize. If you're buying real estate, holding real estate, flipping real estate, whatever you're doing in real estate, it doesn't hurt to talk to Chris. Maybe it makes sense, maybe it doesn't, but at least you had the conversation with Chris. And even if it's a year from now, 2 years from now, you're doing real estate, talk to Chris because Chris is obviously next level from your CPA. Someone who can help you where a CPA will not. Just file a return. This is not that. This is such a cool thing, Chris. I love it.
Yeah, and also in the CPA's defense, literally 10 out of 10 times, they always go, okay. It's not that they're against it.
They don't care.
They're just like, if that's how you want to spend $5,000, you want to get the $200,000 now. You know what they're thinking of? Are you going to give me a bonus? You're like, no.
So Chris is making it's a funny thing, but it's true. Why wouldn't you spend $5,000 more, whatever it costs, to get back 10 times, multiples, depending on what it is, right? Depending on what it is. I love it. Why wouldn't you? And that's where a lot of savvy.
It's all about the next property. I want to help you get to the next property, get a down payment for the next property so you can do it again. And I think that's where my goal is to kind of hold you accountable. And I'm going to share this with you one more time. Please forgive me. Is if you have more than 3 properties and both you and your spouse are not W-2 employees, I want a conversation with you so I can coach you on how you can have a conversation with your CPA so you can become a real estate professional. And now, no matter what you buy in the future, it's the cost segregation is going to offset your total income. But you got to have some coaching because your CPA, there's no money in it for them. Like they don't get a bonus if you become a real estate professional. It's just so I got to coach you a little bit.
Yeah, it's more work where your CPA wouldn't do it. And again, Chris, you mentioned You know, you guys have been in this business. Your founder was part of actually setting up the regulations for
Yeah.
cost segregation. So, guys, as far as Protect Wealth's concerned, there's nobody better than working with Chris and his team at Cost Segregation Services. Really, truly, because they're the experts, and that's why we have someone like Chris on. So, Chris, seriously, thank you so much for being on tonight. It's been fascinating. Great questions, everybody. And yes, a lot of you asked about recordings. We'll send the recording usually within 24 hours. Will be sent out tomorrow from Zoom. Actually, it comes in our Zoom email. But Chris, you're a popular guy. Everyone's going to reach out to you. Sounds like.
Thanks, everyone. Thanks, everyone. Thank you all so much for your time, Don and Kendall. Thank you for the opportunity to, I know these are your relationships. So I'm always honored when somebody is willing to share those relationships. And y'all just have a wonderful day. Wonderful
We're honored to
evening.
have you on, Chris. Thank you so much for coming and sharing your expertise. It really is cool to know you and have your expertise on here. Thank you again.
Thanks,
Thanks,
guys.
Chris.
All right,
Kevin.
everybody, have a great night. We look forward to seeing you at upcoming events, webinars. Stay tuned. We'll send you some emails and watch the recording from Chris. Thanks for coming, everybody.
Thanks.
Have a great night.